Tony, I've recently inherited some accounts from my father's estate. His advisor was a stockbroker type, and he was with him for years. Over time, it's done quite well, but I'm not sure I've got the stomach to have all of this money in the stock market. Can I invest my money in safer territory with you and not trigger taxes on this money?
Very interesting question. And with so many people now having so much money and starting to pass away, we're seeing more and more baby boomers, adult children who are starting to receive, in some cases, very, very substantial inheritances. In fact, in 2023, we had 55 of our own clients die, and I'm in most of these meetings. I'm meeting with adult children to try to figure out, number one, what are they going to receive? And number two, more importantly, sometimes, what are the tax ramifications of the money we're about to receive? Now, in Scott's case here, let's walk over to the whiteboard because I want to make a distinction and imagine we're receiving two different types of assets so Scott will understand what's taxable, what's not, and if it is taxable, how much money is he going to have to pay in taxes on this inheritance? So in our example, and again, we're running into this more and more, folks, we have adult children constantly coming to us after their parents, our clients, are passing away. And I see things like this all the time. We're going to use round numbers so I can keep this very basic. But again, there was an inheritance received by this son from the death of his father of $600,000. And what we're going to assume of that $600,000, $300 was what's called, we'll abbreviate it, non-qualified. And we'll just say this was a basket of stocks that his father had owned at the time of his death worth $300,000. The father also left to the son, whenever you see the word qualified, that means qualified for tax treatment. That's right, this was a tax-infested IRA. So remember, folks, these IRAs are wonderful. 401ks are wonderful savings tools. The problem at death, your heirs are more than likely going to have pay a boatload in taxes on them. And I'll show you the advantages of leaving something as to what we call non-qualified for tax purposes at death versus qualified. All right, so there's a key term that's used called your cost basis, okay? And let's say this father, over time, had invested $100,000 in this basket of stocks. That would be his cost basis. So the father during his lifetime said, I don't want these stocks anymore, I'm just going to sell them. Well, obviously, there's a gain of $200,000 there. If the father would have sold these stocks during his lifetime, he would have had to pay capital gains on $200,000 of gains, all right? Let's keep going. And let's say his cost basis of the IRA was $100,000 as well. Same thing. It's a little different, though. If he had sold and liquidated the entire IRA during his lifetime, he does not get to deduct the cost basis. In other words, the full $300,000 would be fully taxable, and not at capital gains rates, which are much lower, but at ordinary income tax rates, which again, we'll do some calculations in a minute, some big numbers here. So let's go back to this. This is important because at death, it's called a step up. So since the father held onto these stocks and it was a non-qualified account, the son got the full $300,000 with no taxes, okay? This applies to real estate and a lot of things. Huge advantage there. But what happened over here on the $300,000 IRA? There was no step up in basis. Let me grab this blue pen here. They would take the $300,000, and let's say the son was making a good income right now. Maybe he's a physician or a high-paid executive somewhere, and let's say he was in a 40% tax bracket. He's going to owe the IRS $120,000 in taxes. Now you said, well, couldn't he stretch that out? Well, you used to be able to stretch it out over your lifetime, but not anymore. If you're a non-spouse, you have to pay that out within 10 years. And this is a huge dilemma. They understand when they recently changed the law to make all these beneficiaries take this money within 10 years, all this tax revenue was going to flow in.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips. And be sure to hit that like button and that subscribe button for more videos.